Hello everyone! Today we start studying finance part of the module, and in this particular lecture we will focus on the firm's financial environment. And here is our study plan for this week. First of all, we will learn what exactly finance is and what is the difference between finance and accounting. We will then proceed to study key functions of finance and its basic principles. And after this, the main part of the lecture will be focused on the firm's financial environment. Financial markets, their role, importance, and different types of financial markets which you can come across, and also financial intermediaries, again, their role and importance, and various types. So what is finance? The finance function is vital both for an individual company and the country as a whole. In the UK, financial services account for a larger proportion of the national output than the whole of manufacturing industry. There are more than 6 million people employed in finance, banking, insurance, and other finance-related businesses, compared to only about 3 million in manufacturing. Financial sector provides valuable intermediary services and contributes greatly to the ability of other companies and sectors to operate efficiently. One of its main functions is to accumulate savings and channel them towards productive investment, which increases society production potential. Without a vibrant and well-functioning financial sector, the society would be significantly poorer. So, finance, as a science, is a study of how people and businesses evaluate investments and raise capital to fund them. In simple terms, it focuses on how to get and use money. Finance attempts to answer three key questions. First of all, what long-term investments should the firm undertake? This involves capital budgeting decisions, in other words, how to spend the available money. Second question, which finance addresses, is how should the firm fund these investments? This involves capital structure decisions, in other words, how to get the money for future investment. And the third question is how can the firm best manage its cash flows as they arise in its day-to-day operations? This involves working capital management decisions, in other words, how to manage cash or liquid money. So three main questions of finance are what long-term investments should the firm undertake, how to fund them, and how to manage its cash flows. And in order to answer these three questions, a company and organization should make three types of decisions: capital budgeting decisions, capital structure decisions, and working capital management decisions. We will study some of these concepts in a little bit more details in future lectures. And of course, we will also cover them in some other modules that we will do later. There is a significant difference between finance and accounting. Accounting, or financial accounting, concentrates mainly on record keeping of recording existing transactions and submitting of financial statements, while finance focuses on carrying out analysis based on information provided by these financial statements, provided by accounting function of the organization, and on making decisions. So accounting function records transactions and provides data, while finance analyzes this data and helps to make informed decisions. The second important difference between finance and accounting is that financial accounting mainly concerned with the past, while finance is much more interested in present and the future. Let's have a look at this statement in a little bit more details. Two main functions of finance, as I just mentioned, is analysis and decision making. Analysis in financial services involves organizing and evaluating data. Financial analysts produce real-time reports for their clients, allowing them not just to get basic data, but also in-depth understanding of what is actually happening to make informed financial decisions. For example, financial analysis of corporate data can help managers to develop a new strategy, to decide whether to launch a new product, or to evaluate whether it was successful, which products are loss-making, and so on. Or financial analysis can also help external investors to decide where they should invest their capital, which company is likely to generate higher profit for shareholders and therefore a higher return on their investments. That is why financial analysts' role is to investigate, analyze data, and formulate an informed opinion within their area of expertise, based on data provided by accountants. This is the first function of finance, analysis. The second function of finance, which logically follows from the previous one, is decision-making. Key aspects of financial decision-making include financing, investment, dividends policy, and working capital management. Again, you will study these in significantly more details in other modules. We can also distinguish different areas of finance. First of all, business or corporate finance, personal and public finance. Business finance focuses on helping corporations to raise funding for their investment projects and develop actions to increase shareholders' value. Personal finance area deals with issues like smart strategies for banking, budgeting, financing large purchases, credits and loans, managing debts, decisions on whether to rent or buy your own property, insurance, retirement plans, taxes, and so on. Public finance focuses on financial decisions made by government entities, government revenue and expenditure, managing budget deficit or surplus, and national debt, issues which are related to government fiscal policy, which we studied in economics part of this module. At this stage, I would also like to introduce you to 4 basic principles of finance. First principle, money has a time value. A very, very important principle. What does it mean? It means that a pound received today is more valuable than a pound received in the future. For example, due to interest or investment returns, risks associated with delayed payments, and so on. We will have a separate lecture on time value for money. This is a very important concept, so please pay attention to it. Next, second principle. There is a risk-return trade-off. In other words, higher returns are associated with greater risks. If you want to obtain high returns from investment, you must be prepared to take higher risk. And the other way around, lower risk investments, safer investments, usually come with significantly lower returns. It also implies that you should only take additional risk only if you expect to be compensated with additional high return on your investment. Third principle, cash flows are the source of value. The thing is, profit is an accounting concept designed to measure a business performance over time. As we know, it's the difference between revenue and costs of the business. The problem is, accounting profit recorded in your financial statements does not always mean that the company has substantial amounts of cash in their bank account. Even if you are profit-making, it doesn't mean that you have lots of money to spend. And the other way around, you can have significant amounts of cash in bank and still be loss-making. While cash flow represents the actual amount of money that the company has at its disposal, which can be taken out of business for investment, distribution to shareholders, and so on. Cash flow management decisions is an important part of finance function within any organization. As future accountants, you will learn cash flow management in significantly more details, as you will have to deal with this in your professional practice. And the fourth basic principle of finance states that market prices reflect all available information. In other words, a price of financial asset includes all information available to investors at this time. All news, all available corporate data. As soon as new information is released, prices will react because investors respond to new information by buying and selling their investments. For example, company stocks. If there is a positive news about future prospects of the company, for example, a new successful product is launched, share prices are likely to go up. The price will immediately reflect this information. And again, the other way around. If there are negative news about the company, for example, it's involved in some court proceedings, or a launch of a new product was not successful, or its revenue is declining, many investors will start selling their shares, and as a result, price will start to decline. Stock prices, market prices on financial assets reflect available information. These are basic principles of finance, and you will study these principles in significantly more details later in your course.